Group health insurance is usually a company's second largest expense. It is also one of the most emotional decisions a leadership team faces because it directly impacts the lives of their employees. When renewal notices arrive with an aggressive rate jump, most employers blame the economy or the rising cost of healthcare. But while the market does shift, these hikes often feel inevitable because of the specific way an employer's group is presented to that market. It raises the question of whether the price is high because of the economy or because of the limitations of the person shopping the plan. Absorbing a 15% increase every year creates a compounding effect that quickly makes a benefits program unsustainable. With only a limited shelf of broker products, your only option is paying the increase or cutting employee benefits. Feeling trapped by these massive rate hikes is often a symptom of the system you're operating in, rather than an economic certainty. A captive or single carrier broker is tethered to one or two specific insurance companies. They're incentivized to keep you within that narrow ecosystem. Employers often fall into this trap because sticking with a default option feels convenient and lowers immediate friction during the setup phase. An independent broker operates without those restrictions. They aren't loyal to a carrier's production targets. They are loyal to the business they represent. For example, Diversified Insurance Brokers maintains active contracts with over 100 different insurance carriers and offers access to over 1,000 products. This level of access changes your leverage. Instead of accepting what one carrier offers, you force the entire market to compete for your business. Who represents you to the market dictates your bottom line far more than the specific plan you select on day one. This comparison highlights how different broker structures handle market access. A captive broker offers a simple process, but you are restricted to a single menu of options. This often results in a mismatch. You end up forcing a diverse workforce with unique needs into a rigid, one-size-fits-all plan. The independent model opens the door to 100 or more carriers simultaneously. This allows for precision. If you have employees in multiple states, an independent broker can match the workforce to the specific carrier network that performs best in those regions. While this requires a deeper strategic discovery at the start, it ensures your plan is actually aligned with your company's geography and demographics. A single carrier cannot account for the complexity of a scaling business, making broad market access a necessity for controlling costs. The difference between these models becomes most apparent during the renewal phase. When a captive broker receives a raise like, they have no leverage to push back. They can't threaten to move your business because they have nowhere else to take it. An independent broker begins the renewal strategy months in advance. They submit your group to competing carriers to generate real, quantifiable alternatives. You can then use those competitive offers as leverage, either to force your current carrier to lower their price or to move seamlessly to a better plan. Leverage only exists when your broker has a credible path to a competitor. Without it, you are simply a passenger to the carrier's pricing decisions. There is also the matter of day-to-day administrative burden. Many employers experience a spike in activity during open enrollment, followed by total silence for the rest of the year. Even though that broker is absent, they continue to collect a commission that is baked into your monthly premium. When an employee has a billing dispute or a compliance question in July, the business owner or HR manager is often left to handle the friction alone. An advisory-focused broker acts as a year-round extension of your team, handling claims issues and administrative tasks as they arise. You are paying for a service through your premiums every month. You shouldn't accept a relationship that vanishes once the ink is dry. Finally, we have to look at where the broker's loyalty is structurally placed. Captive brokers are often influenced by carrier volume quotas or internal production targets. This creates a financial incentive to keep you with a specific carrier, even if a competitor is offering better value for your employees. Diversified Insurance Brokers is a family-owned agency that has operated independently since 1980. They don't answer to carrier quotas. Because they are free from those agreements, their advice is aligned solely with finding the most cost-efficient deal on the open market. An independent broker operates as your advocate. A captive broker operates as a salesperson for the insurance company. Broker commissions are built into your standard premiums, regardless of which broker you use. If you settle for a limited or transactional relationship, you are paying for strategic value that you aren't actually receiving. Use these 3 criteria to audit your current relationship. Does your broker present multiple competitive quotes at renewal? Do they start the process 90 days early? And do they handle the daily administrative friction? If your company is comfortable absorbing 15% rate hikes every year and doesn't mind the administrative burden, staying with the status quo is easy. But scaling businesses that need to optimize costs and reduce complexity cannot afford to be passive. If your renewal increases feel like a guarantee and your broker is unreachable after February, your business has outgrown its current representation. Diversified Insurance Brokers was founded to solve exactly this problem. Their ability to shop the full market across 100+ carriers forces the competition that drives down your long-term costs. This approach moves group health from a yearly crisis into a sustainable business strategy that helps you retain your best people. You cannot control the healthcare market, but you can control who represents you in it. Choose an independent advocate, secure your market leverage, and stop accepting renewal shock as an inevitability.